seller is paying for the buyer's commission as it stands today. So they would buy a client would come in, they'd buy a $900,000 house. They would put 20% down. This rate is lower today than it was when I did this. So, but the rate's not super important for this. They'd put 20% down. Seller would pay, they would have closing costs of about 200,000 or 199,523. That's with taxes, insurance, everything. If you guys have a buyer broker agreement and you're getting a fee of 2.5% and the buyer has to pay for it, you can see that their closing costs increase. So going from 200, just under 200,000 to about 217 if they're paying that 2.5%. The third option was something I wanted to show you is that you can always ask for a seller credit, and I think that's been discussed. But I just kind of want to show you what it looked like. So to make it work, typically you would go over, right? Because you're asking for a credit from the seller and the seller still needs to net the same amount. So raising the purchase price from 900 to 919 and then getting a seller credit. So you can see that their closing costs don't change a whole lot. You go from 199,523 to 199,831. But what does change is the monthly payment. So it's $147 a month. Some things that are going to be important going forward is not all loans allow concession, meaning they won't allow. So currently in a VA loan, a buyer or a veteran cannot pay a buyer's commission. Like it's not allowed. There's been some frantic requests by different parties to get VA to rewrite those guidelines, and they are rewriting those guidelines, but they're not there yet. So depending on how much your buyer is putting down, that will limit the amount of credit that you can get. So meaning the amount of seller concession. So if your buyer is putting down less than 10%, which is the majority of buyers that we work with are putting down less than 10%, they can only get a maximum of 3%. That means if you're asking for a closing cost credit of 2.5% to pay for your commission, they can only get 0.5% more. You just need to know that, because what happens is if the concession is too big, the loan's just not able to close. And this is all banks. All lenders will say, the concession is too great, you can only get 3%. So you need to know that going in. With FHA loans, that limit is 6%. So ask for whatever you want. If they're putting down 10% or more, then it goes to 6%. And this is all assuming owner occupancy. The concession limit on investment properties, so this is one you want to remember, it doesn't matter what they're putting down. On investment properties, you can only get a seller credit of 2%. So just be aware that if you're helping your investor buy a rental property, which you may run into a lot of those, seeing as you guys have a huge referral source that is investors, right? Just know that you can only get a 2% credit on an investment loan, and that's on all different types. So if you have that 2.5% buyer agreement and your client wants to write on a property where the seller isn't giving up, so this is the worst case scenario, the seller isn't giving any concession, you need to have that conversation with your seller that we can only get 2%, so you're going to have to figure out that 0.5% because you signed this agreement. Those are the key points right now from a lending standpoint. We've had some questions like, is this going to change? Are we going to update this? Like, are the guidelines changing? So far, they're not, right? And so we've still got a few months before this actually rolls out. So we may see some guideline changes, but at the moment, that's what it looks like today. The things you need to realize is that you can typically get a minimum of 3% of a seller credit. You still have to negotiate that. You still have to ask for that credit. But from a lending standpoint, that still works.
Hey, Jeff, I have a question in regards to how that looks on the addendum. So if we say seller to credit buyer 2.5%, we don't say towards commission.
No, you just say towards closing costs. As soon as the buyer's paying it, it's considered a third-party fee, right? The same as paying for title, paying for escrow. Your commission now is just part of a third-party vendor fee that in a loan standpoint.
So I wanted to make sure everyone understands that it's kind of two different conversations. The conversation you're having with the lender is it's just 2.5% to closing costs. You don't mention that it's to cover the buyer's payment to you.
100% right.
Right?
Yeah. So just always to remember on concession, like whenever you get a credit, there has to be enough fees there to absorb all of that, right? So a lot of times people will say, well, I got a $30,000 credit. I'm like, great, the closing costs are 10 grand. What are we going to do how are we going to spend the other 20? You know what I mean? And so in my ideal world, there's a lot of communication between you and the lender. This is where we excel, by the way. But there's a lot of communication back and forth of like, how much credit can I get? What can I do with that? Your lender should be able to express to you, this is how much our closing costs are. If you get more than that, we can actually get the rate down to here. But you need to have that conversation as you're asking for either a concession or a price reduction, because sometimes a price reduction ends up benefiting the buyer better, right? So if they need to make up 30,000 because of something that was discovered, like sometimes a $15,000 reduction and a $15,000 seller credit makes more sense than just a $30,000 credit. So sorry, that was a long-winded way of saying talk to the lender before you ask for credits.
We want to get into it.
Yes, sir.
Get into it.
DSCR loan.
Yeah.
So how do they have to prove the rental income? So let me give you this scenario. Lady's looking at a 3-bedroom, 2-bath condo.
Yes.
And 2 of her kids are going to go to Fresno State and stay there.
Yeah.
And then they're going to rent out the other room.
Yep.
But that's not going to be enough income to be more than the mortgage payment. So would that not count, or can you just give a number for the whole property?
You would give a number for the whole property. So the guideline is for DSCR loans. Sorry, I always just quote guideline. It's like quoting scripture, right? You always just go back to the verse, right? So the guideline on DSCR loans is they will take the lesser of an actual in-place lease, which it sounds like they don't have because they're purchasing the property, or what they call a market rent survey. So that's where the appraiser goes out and says, based on other 3-bedroom, 2-bath condos in this area, we think you can get a rent of X.
Okay.
And they give you that number. And then with DSCR, what you want ideally is for that to cash flow. You want there to be a $5,000 rent with a $5,000 payment. That doesn't always work where rates are, right? There are some DSCR loans where you can actually do 30% down instead of 20% down. I know that's not every client, but when they actually have no top ratio, which is weird. Like, as long as you say it's a rental property, they'll let you buy it. Those rates are not as attractive, but we're finding that sometimes is a better solution than just a straight DSCR, because it's hard to get, with rates where they are, it's hard to get the rents to cover the payments. I like that you guys go straight into the weeds. You're like, let's talk about the difficult loans.
Right?
Just so you know, we do all those. We also like the sweet vanilla loans, like the really easy ones. Like, we're okay with that. But either way, keep going, Daniel.
Credit score. Isn't it like minimum 700? Is that right? Or is that not right?
No. So that's going to vary investor to investor. So we have some that'll go 620 credit scores. We have some that'll go 640. If you guys want, I can talk DSCR next time. Like, I can put together a full presentation on that and give you guys a good 5-10 minutes of like high points, because that's like, it's a whole different loan, right? Like, it's got a whole different set of guidelines. But yeah. I think a good rule of thumb for you to remember, Daniel, is like the lower the credit score, just the higher the rate's going to be. There are investors that will take on relatively ugly credit scores as long as the property cash flows or the borrowers are putting down enough money, right? So like, sometimes it's just like, yeah, we'll do it, but you got to put down 30%. Like, it's not like the loan doesn't exist, but you're just going to have to come up with a whole lot of money, which not all investors can. But I think for you guys, particularly all the referrals you get from the property management side, like, that's a good moneymaker. It's not an easy way to go there, but DSCR loans are the cleanest way to close a loan. The rates are a little bit higher, but like, it's literally, you get an appraisal, the appraisal comes in, this is the rent, that's it. Like, we don't care what you do for a living. If they're a super easy loan to qualify, and for investors that are just trying to acquire property and keep moving, like, it's a really easy transaction. And the guys with 15 to 30 properties, we don't care how many they have.
Can you explain to the group what a DCSR loan is for investors, how it is different?
Yes. So normally you're qualified on income, assets, credit. So basically they look at like, okay, if you buy this rental property, you have this job, like, they look at your entire package. What a DSCR loan is, the DSCR is debt service coverage ratio. And so what they're looking at is they basically treat the new investment property, and DSCR is only for investment property. They treat the investment property as its own separate entity. And they basically say, does this cash flow? Does the rent that you're going to receive on this new rental property cover our projected payment? And if it does, we're okay. Like, we don't care about anything else, because we're going to treat this as a separate transaction. And it's almost like an SBA loan or a small business loan. Like, we're just looking at this new business, right? So we're looking at this new investment property. Does it cash flow? The benefit there is if you have a down payment, you can qualify for a loan that maybe you wouldn't qualify for in a traditional way. And I want to preface that by saying just because people don't qualify doesn't mean they can't afford it, right? So a lot of times people are self-employed, they write off a lot of their income, they don't show a lot of their income. You have cash businesses. I see this a lot with like landscapers. I see this a lot with realtors. I see this a lot with, anybody who's self-employed who can make money and not necessarily have to show it to the government because they don't want to pay taxes. This is where this fits really well. And so it allows them to buy and acquire rental property without having to show, the normal amount of income. So what I'll do is I'm just going to note to myself to get some DSCR kind of easy takeaways for you guys so that when it does come up and you have an investor, really the referral for this one typically comes from, I went to the bank and they said I couldn't buy a rental property. You guys as agents would say, I have a specialist who does rental properties a lot. He does a lot of financing for rental properties for self-employed borrowers or borrowers with tricky tax returns. Those are the guys that we're looking for because it really lets us just hit the easy button.